Tuesday, 3 p.m. Real estate investing Zoom. This is the LA County Real Estate Investors Association. We get together every uh, Tuesday, 3 p.m. Pacific time, and we get together and talk about all things related to real estate investing. Really excited. I'm the official podcast for the event. We host our event live every Tuesday, but we do in person a real event on Tuesdays of, I'm sorry, Thursday, the second Thursday of the month. We get about 250 people for a class or a presentation. We get about 50 different vendors you can meet. So the idea is that in addition to online and phone calls, you can get together with people and meet them, meet vendors to help you build your business. I've used vendors I've met here for taxes, incorporating, insurance, helping me. Really, I've made probably $50,000 in commissions from vendors I met there. And then a great speaker starting at 7 o'clock, Rick Sharga. And this is a free event. It's in West LA at the Iman Cultural Center, Motor Avenue, just south of the 10 freeway. Hope you can be there. And if you are, I'm the official podcaster. Come up and say hi. We'd love to have you visit us and come to the event. We do it every second Thursday of the month. On the second Wednesday of the month, the same event is held in Ventura. And then on the second Thursday event, we do it here in Los Angeles. I'm Bill Gross. I'm a real estate broker here in the Los Angeles area. I do this to meet people, to help people who are new to the business, who are looking for a pathway to building more income and more wealth in their lives. And that's how we use real estate for, is both income. I'm a real estate broker. It's how I make a living. And then the money that I make extra, I invest in real estate. And so I come to this program to meet people, network, and to help find better ways to put my money to work so I don't have to work as hard or as long in the long run. Really excited to have a guest today that I've met before and we've talked about before. Really does a couple of things. Is really a special master in. We previously talked about 1031 exchanges and Delaware statutory trusts. But one of the other topics that people, before I get there, let me just say, if you're watching this on our social media, Facebook, LinkedIn, YouTube, on live, feel free to put questions there or comments, links, your contact information, and I'll do my best to participate here. We want this to be interactive. We used to do this live on Zoom. We found we get better action on YouTube and Facebook. I see a bunch of you lined up on YouTube already. So feel free to participate there, and we'd love to have your questions or answer them. Anyhow, I want to introduce, I'm excited to bring to our program today a man that I've had on before, Lyndon Grey. He's a financial advisor at WIS, and one of the topics we talked about in the past was about 1031 exchanges and DSTs, which is ways when you sell property to defer taxes or maybe make them go away if you can magic wave a magic wand. Today, though, he's going to share with us, I found really exciting, some insights on opportunity zones. Lyndon, welcome back to our program.
Thanks, Bill. Appreciate it. Thanks for having me.
And not only do we see you here online, but we also see you in person at the LA Real Estate event. You're a vendor there. We've seen you a few times. You plan to be there this Thursday? Will we see you there live?
Yeah, I do plan to be there.
In real life. Okay, very good. So let's talk about opportunity zones. What are they generally speaking?
So basically, in 2017, under the Tax and Jobs Act, under the Trump administration, the opportunity zone was put into that bill. It's a bipartisan legislation drafted by Senator Scott out of Carolina, South Carolina, I believe, and then Senator Cory Booker out of Jersey. So it became widely accepted from both sides of the aisle. And the main crux of the legislation is to incentivize private money to move towards blighted area. And one way to incentivize the wealthy is to give them a tax break. And the legislation basically says, if you're in an asset for a decade, you have to, then you get the full tax exemption on that asset. So if $1 million turns to $2 million or whatever, there's no gains to be paid. Those dollars can go right into your checking account with no liability because they participated in an op zone. So yes, it came out in 2017, but it wasn't until maybe a year and a half later that some of the big boys came along with Opportunity Zone funds because they needed to really have their legal departments go through all the legislative particulars to make sure they did it correctly. And so Inland, Cantor Fitzgerald, Griffin, some of the big real estate operators in the country came out with their respective funds, multifamily, life sciences, and so forth. And right now, Inland has an Opportunity Zone fund with three A-class amenitized properties, one being right here in Southern Cal next to USC. And people might say, whoa, USC, that's an Opportunity Zone. But remember, the Opportunity Zone legislation took a decades old census. So a decade from when the legislation started in 2017, the governors of each state basically looked at 2007 census information and kind of put a map together and say, okay, we're going to deem this area an opportunity zone, this area an opportunity zone, and so forth. So that's how SC is in there. Yeah, exactly.
Well, so what you're saying, you're kind of answering, which was my reaction, which is number one, when I think of opportunity zones, I think of disastrous areas, the last place I'm going to take my hard-earned savings and put there to work. However, there's always inefficiencies or the edges that are where the opportunities are, right? And having been I went to school at USC. This property we're going to talk about an example. If you know the campus, north of campus was tremendously redeveloped. West of campus has been there's some nice projects going on there. The south side is the museums and the Coliseum, and on the east side, directly across the street from campus, has also been massively redeveloped. But south of Exposition, across from the park, had been blighted. As long as I was a student there, it was a blighted area, and it was where the Trojan Barrel. What was the name of it? For years, somebody's Trojan Barrel used to be where we'd go before the games and park and drink and then walk to a game, whatever. And this opportunity zone took a couple properties, put together this massive project. In fact, let's show it. I know you were nice enough to send in. I wanted to kind of give you a chance to tee up a little bit. But you brought up one of my favorite subjects, which is taking blighted property near USC. This is the campus up here. This is south of the campus where the park is, and the Coliseum is to the off the center. And then I think this is the property you're talking about, the hub. You can see how these older buildings are nearby, but you have this beautiful development. Talk a little bit about what this is.
Yeah, so basically that's, I think 79 or 80 units and about 350 beds. It's fully amenitized, rooftop pool, study hall, rec area, gym. On the bottom floor, there will be, I think, a Buffalo Wild Wings for students to congregate and watch the games and have a beer and so on and so forth. But it's fully leased up with waiting list. So you can imagine everyone wants to be at the new property with all the swanky amenities. And Inland, this is one of three properties in the Inland portfolio. Inland is a major player in the real estate space. They have about a $4 billion multifamily portfolio of properties across the country, in addition to industrial, in addition to self-storage. And they're the biggest landlord to Walmart, CVS's, et cetera. And so this will be one of three. The other two will be in Florida. One is next to University of South Florida in Tampa. That's basically it's leased up. And then the last one, they broke ground next to Florida State in Tallahassee. And so there'll be three properties in the portfolio. And the idea is you put these in a portfolio where clients who are selling shares of Amazon that they bought 10 years ago for 100, now they're selling them at 2,000 or much higher, or shares of Apple and so on. and they wish to reduce their capital gain or defer their capital gain and have a full exemption, they can say, you know what, put $500,000 into that portfolio or put $1 million into that portfolio. My kids are 7. By the time they get to be 17, 18, those dollars can then be utilized for college tuition and so on and so forth, because they'll be fully tax free, as opposed to selling appreciated assets and paying taxes to meet their college needs and so forth. So that's the goal of the portfolio.
What's amazing about this particular property, if you know the area, this is the south side of the campus, the south corner. This is the Galen Center, which is where the basketball team plays, the volleyball team plays. And for years, there's a hotel here, and they put in commercial, they put in some restaurants. And so if you went to a basketball game, you go to and have you'd have a meal, or you could stay over at the hotel. Visitors could stay at the hotel. But this was blighted. This is the 110 freeway going north to downtown, south to the harbor. And this was rough. If you came down the street to park, if you broke down here, man, you were in trouble. This was bad. But you can see it's right across the street from the arena where the basketball team plays and high-end hotel and restaurants. Across the street from the brand new soccer to American stadium. They changed the name. It was Bank of California. Now it's called something else. And the Coliseum, which is being remodeled as well. And so it's this terrible area, but with all this money, you've now made blighted into first-class facility. Look at this thing that they've built. And it has here the different floor plans, and you can see there's 1 bedroom, 2, 3, 4, and 5 bedroom. And imagine the 5 bedroom is because you have is this student housing, or is this going to be family housing, or who's going to live in these houses?
It's all student housing. With student housing, it's kind of priced a little differently, as opposed to, even though there are 80 units, you basically charge per bed. So it might be a 5-bedroom, 5 roommates, but each bed is charged of a rent, if you will, and you pay that rent to the landlord.
Got it. So you can see the studios and the 1 bedroom and 2 bedrooms are sold out. And so what's happening here is you're just going to share the facility with more roommates, and there's different pricing based on how big yours is and which of the configurations. If you have the view, you don't have the view, and then it shows what the shared spaces look like. Full-size washer dryer in each unit for students housing. That's unbelievable. Maybe I should go back to college. I didn't live like this. Not at all. And the amenities, rooftop pool you mentioned, health and wellness, is a workout room, study areas. So this is like the equivalent of maybe not A quality, but maybe A- quality facilities in a regular market for student housing. And
Definitely. Where you can just walk across the street and go to campus and go to class, or scooter up to the Staples Center or downtown LA and scooter back within 30 minutes. So it definitely puts you right there. And the beauty about this, it's off campus. So during the pandemic, you had situations where housing on campuses were closed, and students were told to go home and attend class via Zoom and so forth. Well, these properties are not affected by any mandates like that, because they're privately owned and they're not on campus. So the university can't say, okay, you have to leave. These are off campus, so that makes them kind of not affected by those kind of events.
when I went to college, when I went to USC, off campus was some pretty rough housing, and I actually lived 3rd Street in Vermont, and took a bus down Vermont to get to campus. For the money, I got a much better place. I could have right near the campus. This is a whole nother level of student housing. But again, this is because you're building a huge project. There's certain economies of scale. So somebody who's investing in this, what are the numbers like? What's the investment opportunity for somebody who participated in this event, or the next one? What kind of returns should somebody expect going into?
The projected returns are anywhere from 10 to 12% annualized. So over a decade, you're certainly anticipated to double your money. $1 million turns into 2 or 2.1, et cetera. So you sit on these assets, and a decade, As you approach that decade, you start shopping the assets to endowments, pension funds, insurance companies, et cetera, because they love stabilized assets
Right.
and assets that can move with inflation in terms of the rent roll. And with student housing, as you can imagine, you have such turnover that when the next freshman comes in or sophomore comes in, you bump the rents 10, 15%, et cetera. So if you're a pension fund or an endowment, and you're looking for your retirees to your firefighters, your school teachers, your police officers who spent 20 years on the job, they retire, they need they need their pension. Well, these assets help fund those kind of
Right.
cash flow. And so pensioners and foundations and endowments, they love these stable assets and the ability to raise rents. And then later on, they will sell that asset as well for a gain. So yeah.
We just saw last week the Park La Brea facility. I think it's the largest multifamily in the Western U.S. Just got refinanced for about $1 billion.
Yeah,
And in a market where it's hard to get finance, that's all you hear about. It got financed on really good terms. Why? Because it's a long time. It's about a 50-year project now, and it's been stabilized over time to where they know the numbers and they can project based on what's happened last year. And rents are going to go up 2 or 3% per year minimum. And if you have a fixed rate mortgage for 10 years, they know they're going to end up coming out way ahead on that. And the next buyer buys it and does the whole thing all over again. So that's what this asset's going to be, right? 20 years from now, we're going to see somebody's going to buy this and they'll probably freshen it up and repaint it and add
exactly.
some new amenities or something. But then they'll
Exactly.
redo the whole thing and they'll pay out the investors of that program.
Exactly.
As an investor, what's the minimum investment? Is it for accredited investors only?
Minimum is 100,000. It has to be, you have to be an accredited investor,
Okay.
meaning 1 million or more in net worth, excluding your primary residence. So, and for the realtors on the call, who have investor clients who are searching for a 1031, but they miss their exchange window or they fell out of escrow in the 40th day and now they're faced with a taxable event. The opportunity zone could be a lifesaver because you can utilize an opportunity zone, even though monies have been received or sitting in your checking account. You've taken constructive receipt. You can still qualify for an opportunity zone because the legislation basically spells that out. In addition to that, you have 6 months after escrow closed to then move monies into an opportunity zone fund for tax deferral. Taxes are deferred till 2026, payable April of 2027, and then you have full tax exemption over the decade after the asset is liquidated.
So that's this project, but this one's really closed, right? The investors were taken and they bought the property, they fixed it up, and this is ongoing and it's an ongoing event. So somebody who wanted to invest in the next project, what's available today, or are you allowed to talk about that, or can you give us an
Well,
idea of
this
what that
is
might be?
still alive. This fund is going to be about 350 million as far as the student housing. This property is finished and being leased out and everything, but someone can still participate within this fund. It's not closed yet. Once they get to a number of say 300, 350, then they will close that fund. That will probably be into the beginning of next year or late December.
So the fund has multiple properties. This is one of the properties in that fund.
Yes. So this is one of three. There'll be this property was the first to basically go live, and then the second property in University of South Florida in Tampa, and then the third property, Florida State in Tallahassee, is basically being built now. So those three properties will make up the Inland Student Housing Opportunity Zone Fund.
Got it. So it's a fund with three properties. This is one of them. So as this one improves, you'll see the benefits to this one as part of the
Yeah.
fund.
So people are cash flowing now on this one. So you're getting about a 3% dividend for money that have gone into this fund because it's cash flowing. And once the Florida State and the University of South Florida is completed, you will start to see more cash flow. And it'll cap out at about 5, perhaps 5.5 as far as the cash flow, monthly cash flow. But the big reward is certainly capital gain exemption.
That's a big one. I think if you have capital gains, this is definitely an opportunity to look for. And I think ideally, as a real estate broker, I had always heard customers enamored with 1031 exchanges. As a broker, it was always a nightmare. And I heard Grant Cardone explain why, which was my experience, which was when a customer would get ready to do 1031 exchange, they'd have to identify 3 properties. It's hard enough to find one that you love, and they'd inevitably find a second they were okay with, and they'd scramble and throw in a third. Well, what happened? Always, the one they loved fell out of escrow, or they inspected it, didn't like it, or whatever the problem was. At some point, that one didn't work, and now they maybe have a property they're not crazy about, and then worse would be if they had to go to the third property. And so this is an opportunity where at the last minute, you still have the opportunity to take the funds from with the capital gains, put them into this and defer those gains and or make them disappear over time, 10, 20 years from now. So it's a fantastic opportunity. Okay, so I know it's a little complicated topic, more than we normally go. But if you have questions or comments, I'd love for you to put them in the chat box, either if you're watching on YouTube or Facebook or LinkedIn. We're connected to all of them live through the software that we use. So please feel free to add in there. Lyndon, so you said $100,000 accredited investors. Is there opportunities for people to refer you clients? How does that work?
Sure. If someone wants to refer a client to me, my LinkedIn page, you can reach me there, or my number, 310-954-8384. And certainly we can discuss the situation there. But I certainly work with realtors who have a situation where they can't find a property, or they're getting close to their 45-day window, or it fell out, and we're able to at least save give them some tax relief and full tax exemption with some of the money. You don't have to use one of the beauties about the legislation also is you can retain your cost basis. So if something cost you $500,000 and you sold for $2 or $3 million, you can keep that $500,000 in the bank and not pay any taxes on it, unlike a traditional exchange where you have to account for that $500,000 and pay some tax, because some is cost basis, some is gain, and so on. With the legislation, you can retain all your cost basis in the bank and do as you wish, and you will just fill out a one-pager come tax time with your tax person that says you participate in the Opportunity Zone. Here is the Opportunity Zone fund that I utilize, and so on and so forth.
So you can take back out the original investment, plus I imagine any capital additions you made up until then, up until your
Correct.
basis. And then are you able to take out part of the profit and pay tax on that portion of it, or not?
Sure. If you wish, you can take some of the profit, pay taxes on that, and say, oh, I'm just going to roll $500,000 or 200,000 or 300,000. You're not obligated to roll all gains at all. You can basically do as you wish. Keep some of the gains, keep only the cost basis, and roll the gains, etc.
I have on here California Real Estate Investors, the name he uses on YouTube. Such an amazing topic. It's really, that's why I was really excited to have Lyndon on, because I know him through some other things. And when we started talking about this, he brought Opportunity Zones so close to home for me that all of a sudden I realized what it was. It wasn't about, when you look at the map Opportunity Zones, the center of the Opportunity Zone, it's the edges. It's really where you want to invest, not where, necessarily that metal. And there's a delay period as well. And then also, if somebody didn't want to put all their eggs in one basket, let's say they had a couple $100,000, do you have similar types of programs, Opportunity Zones? I know you do on the DSTs, where you have kind of a menu of different options. Are there other options that you can present besides this one for somebody who might say, hey, I have $300,000, but I just want to put 100,000 one, 100,000 another, and I'm going to use somebody else for the third?
Yes, I do have access to several players in the Opportunity Zone space, like I do in the DST world. So Inland is in the student housing space. Cantor Fitzgerald, which is a 75-year-old private equity firm out of New York. They have big offices, presence here in Century City. on Avenue of the Stars, I believe. And they have a portfolio that's a mix of life sciences and multifamily. One property is almost finished now. It's in Vegas, like a five-story multifamily. And then they broke ground some years ago, about 2 years ago, in Philadelphia Life Sciences building, and that's being leased out even before it's finished because the federal government incentivized a lot of the big pharma to basically get ahead of the hopefully the next pandemic or the next situation. So they really incentivize them to break ground and build out their infrastructure so they can do R&D and get ahead of any virus that might come down the road. So that's a Philadelphia project that was basically vacant land, and now it's almost completed. And then Griffin has a all multifamily opportunity zone fund where they will go into areas and cherry pick certain spots and build from the ground up, or take out old buildings and tear them down and just build straight up.
And geographically, where's Griffin do their business?
Griffin is going to be south in the Midwest and the South and so on. They'll pick properties up in those areas where it's more friendlier to the landlord, and more acquisition cost is much better than picking up property here in Southern California.
It's anywhere.
Yeah, exactly.
Okay, look, this is a very deep topic, a little deeper than we normally go. But the key thing is, if you're in a position where you have taxes coming out of a sale of a property, what do you do with it? And there's all kinds of options. 1031 exchanges, one we've talked about. 1031 DSTs, Delaware Statutory Trust, we've talked about with Lyndon. And then here's the third one, which is opportunity zones, where you can take those taxes and kind of watch the tax obligation of it over a 10-year period. There's some risks involved. That's why these projects are located where they are. But when you have first-class management, first-class builders with a track record, that's the key. And then you might want to diversify. I think rather than put all your money in one, try to find 2 or 3 different projects to spread your money over. This fund has 3 different projects, which is great, but you still might want to try to find 1 or 2 other funds to split your money up. So, Lyndon, you've dealt with this before. There are people who do well with it. Some people aren't happy. What's the biggest mistake either you've seen made or somebody should avoid when investing in opportunity zones?
You stay with the big players, the deep-pocketed players. They can weather the storms, whether it's a downturn in the economy. They have great relationships with institutional money. They're not going to, quote unquote, run out of money because they started a project and the economy had a downturn. You stay with the deep players, the Cantors, the Inlands of the world, the Griffins of the world. They're well proven in what they've done in a variety of asset classes, and they've weathered the storm in '08, the COVID experience, etc. So yeah, you stick with the deep-pocketed players.
Cantor Fitzgerald literally was headquartered at the top of the World Trade Center, which was destroyed, and they're still in business. So you can literally blow up the building their headquarters are in. You're not going to stop people who are that smart and have that kind of money and track record and experience.
And a
So
lot of their talent died in 9/11. It was tragic. They lost a lot of talent in 9/11. But they used that '08, '09 situation to go in and pick up a lot of realtor firms who were really hurting, Grubb and Ellis and some of the other names, and Newmark Knight Frank. That's a Cantor company that a lot of people aren't aware of. So they're one of the big players now in the real estate space. And in crisis, there's opportunity. And in '08, '09, they used that situation to go in and kind of cherry pick a lot of companies that were kind of having trouble.
One thing I've learned in my career is a world of difference between the best in class and everybody else. There's a reason why somebody's best in class. You may not recognize it, you may not see all the factors, but a company like Cantor Fitzgerald, Inland is known also in these kind of funds as being a best in class kind of company. They just do things different. They do them their way, and they succeed because they do them that way. So over time.
And speaking about Cantor, if I will, in 2018, there was a client of mine sold a Santa Monica property for $3 million off of Broadway, and we put $500,000 in an in a DST portfolio, which Cantor had in Vegas, a 400-unit complex. Fast forward to April of 21, that property was sold for $88 million. Cantor picked it up in 2018 May for 63 million. And basically, the client within 2 years, 11 months, that was his $500,000 became 679, which averaged out to about 13% for those 2 years, 11 months. And mind you, that was a COVID price, 88 million in April of 2021.
Right.
Cantor still maximized the returns on that property in light of what was happening with COVID. So just to give you an idea.
These are the masters of the universe. Well, we're like the little ants in the ant farm. They're figuring out where everything goes, and so if you have a chance to work with them, I've been lucky to work with a wealth manager who similarly is very exceptional and gives us opportunities to me to participate. So in the real estate space, this is fantastic. Okay, so I think we covered as much as I really can today without getting with Lyndon specifically. You can reach out to him. He's available on LinkedIn. I put his profile up there. We'll have his contact information as well in our in the description. And then just kind of a reminder that this is the LA County Real Estate Investors official podcast. We do every Tuesday at 3 o'clock. And if you want to see Lyndon or to guilt him into making sure he shows up on Thursday, we get together the second Thursday of the month, which is 2 days from tonight, on Thursday the 13th. At 6 p.m., we get about 250 people who are students or participants or want to learn about something. And we get about 50 vendors on one of them where we get together and share different ways to help you build your real estate business, your portfolio. And it's at the Iman Cultural Center on Motor Avenue, just south of 10 Freeway. And the speaker this month is Rick Sharga, who's talking about real estate investing in an uncertain economy. He's a master teacher on real estate investing, particularly multifamily. So it starts at 6:30. It's free, and there's free parking if you get there early enough. I get there before 6:30. Make sure I get a free spot, and it's a short walk. But love to see you there. If you're there, come up and look for Lyndon. Come up and say hi to me. I'm the official podcaster there. We'd love to have you participate. Lyndon, you take a very deep technical topic. You make it very explainable. I've seen you on various realtor groups. You and I've had the pleasure of talking numerous times. I just want to really, on behalf of everybody listening, to tell you thank you so much for sharing your experience and your wisdom with us today.
Thank you again for your interest and your time, and thank you for everyone for tuning in, and we'll see you at the expo, hopefully.
Fantastic. And again, I'm Bill Gross, is the LA County Real Estate Investors Association. We get to every Tuesday at 3 p.m. live online. We're on YouTube, Facebook. If you're online, feel free to put a comment. We're going to close down the call now, but I'll watch the comments as well. Feel free to reach out if I can help in any way. I'm available on all the social medias at Bill Gross Probate. Make today your best day ever.